So far we've been talking for a long time, so we'll try to speed it up and make this a bit shorter when you look at Europe, because there's not too much in terms of new data. Unfortunately, everything that we've been saying has come true, so it's not. We don't want to rehash some of the different pieces, but we want to talk about the some of the overarching data. So when you look at GDP, came in right in line, came in at about 0.2 versus 0.3, and remember our view was that they're already in a recession looking at Q2. So our view is that the recession is now, not Q1. Our view is that Q1 had enough momentum in terms of what Germany was putting out, in terms of what was happening, that there was enough to sustain that. It's really when we go into Q2 that we see a much bigger problem. Trade balance was negative. Then when you look at CPI continuing to be right at that 7.5%. But then when you look at the current construction output, so the ECB current account was negative. You're starting to see construction slow down. This is from March. April was worse. And then when you look at consumer confidence for May, came in at the low end at 21.1, negative 21.1. But then the manufacturing, the PMI side, so manufacturing expected at 54.7, came in at 54.4. Services was expected at 57.4, came in at 56.3. Again, that was that bigger slowdown that we've been talking about, which means the composite, which was expected at 55.1, came in at 54.9. Now, some of the positive, because again, above 50 is expansion, some of the positive, though, actually has negative attributes to the consumer and to the underlying region, which is supplier delivery times have gone up in Europe. Even as the US was improving, Europe was getting worse, and prices paid also continued to go up, which again is negative for inflation, but again, positive for where things are. So then when you start looking at Chinese PPI manufacturing, you see that Chinese PPI has come down overall, but the PPI X energy for the Eurozone has gone up. Now, I think that when you look at this, the whole concept is that Europe should come down. Now, I look at that and I kind of flip that a bit, and I actually think that Chinese PPI manufacturing goes up, and that you're going to actually see this pivot back up, as we've already seen in terms of those leading indicators. Now, I do think the Eurozone is starting to come into kind of a flattening component, but it's more along the lines of China coming up to meet Europe and not so much Europe coming down. Now, the weakness in China's PMI and in investors' confidence applies significant downside to Eurozone PMIs, which it makes sense. So you have prices going up, prices paid going up, but you have a slowdown because China is a big buyer of European goods. So as China buys less, Europe sells less, which then means manufacturing should come down. New orders, which again, as we talked about, new orders and export orders have come down and are in contraction, showing, I think, what that chart is indicating. All the while, when you look at core inflation, which is now well over on the right-hand side, when you look at 2.7%, and then the negotiated wages haven't kept up, excluding German one-off payments, you can see just how far behind they are. So as documented by the Bundesbank, the jump in German negotiated wages has been driven by one-off payments from previous deals. Back of the envelope calculations suggest the underlying wage growth was closer to 2% rising, but as you can see, still very low and still having those impacts in terms of where the euro area negotiated wages are, what those problems have, and just what the consumer is going to look like as we start looking at what GDP growth is going to be over that time period, especially as natural gas prices go up, gasoline, diesel, and those impacts from the Ukraine-Russian war. Euro area inflation would soar past 9% this year in case of large-scale disruption to gas imports from Russia. And here's I thought this was some really good outlooks, because when you look at the adverse scenario, which we've already come past through, and now what is the severe scenario? And you're starting to see some of these impacts in terms of what is inflation going to look like? And when you start breaking down the cost of electricity and the cost of commodities, you get an idea of the pain and the problems that we're going to be in. Now, the euro area output would grind to a halt this year. And when you look at the severe scenario in terms of the pressure, which is why we've been talking so much about where we are, what the current situation is on GDP, we do, and Lagarde made comment to this in the previous meeting, and so far she's essentially guided to an increase of about 50 basis points. Again, things change, people's minds can be adjusted, but we see the severe scenario as likely and not the new forecast, just because of the underlying problems that we're seeing on the consumer, wages, and some of those key leading indicators. And the global Eurozone composite PMI, again, showing that slowdown, and then the German manufacturing. So the German manufacturing flatlined a bit. Some of that was a recovery in motor vehicle manufacturing construction, but on the service side is where we saw the biggest pain. So Eurozone core CPI, as you can see, is at 3.5%, the highest in this point. Implied ECB policy rate change at the July meeting is at 30 basis points. So that's where, when you look at what is expected, I think there's some wiggle room for what Lagarde can do, and you could see this be right in line with what the market expects. But I think that would create a steepener, something similar that we've had in the U.S. just now since the Fed minutes came out, where you'll get some of that steepening because, again, it just means that the inflationary pressures are going to be able to persist longer, creating more damage and, again, extending that runway. So then when you start looking at the survey for construction confidence has moved negative, and construction output, which is what we've been talking about on, again, some of these movements and that negative capacity coming down. And this is when you start looking, because remember, the latest was April, we got March, and what we're seeing now is April and May, and that movement in the wrong direction, which is why we do think we're already in negative growth territory and are only going to get worse in Q3. Eurozone consumer confidence, right in line, but you can see is still deeply negative and close to where we were during the pandemic, and the problems and the inability for people to spend. And it comes down to some of that Russian reliance on gas, because it's just going to show that increase in pricing. Germany tops the list of nations buying gas from Gazprom, 28.9 billion cubic meters. To give you an idea of just how much that is, the sheer size, which is why Germany, who is really the growth engine, and we keep talking about the consumer, but again, manufacturers also consume this natural gas. And when you think about the loss of sales or the impact of price, this is going to be a huge knock and a huge problem as you see that pressure continue to mount and the problems persist throughout. So the low-income households are at risk, not surprising. Exposure of households to energy price shocks by income quintiles. First quintile is obviously 35%. Transport spending on utilities. Utilities is going to continue to be the problem when you're looking at, and again, draining away some of the ability to spend, the ability to stimulate and move that economy forward is going to be hindered. And now this doesn't even include what the weaker companies can do and how much they're going to have to borrow and how their cost of goods sold is going to go up, and a lot of those underlying pressure points. German wholesale price index came in at 2.1%. Wholesale price index 23.8% year over year. Again, still moving up. Rate of change slowed, but still moving in the wrong direction. PPI expected at 31.3%, came in at 33.5%. Month over month, 2.8%. Business climate improved slightly. Expected at 91.4, came at 93. Current assessment 99.5. Expectations, though, right in line with estimates at 86.9. Still a lot of that fear. Manufacturing came in just above estimates at 54.7, but services weakened to 56.3, creating, again, some of those cracks that we're starting to see. Consumer confidence above estimates at negative 26. Private consumption was down negative 1%. Government spending up 0.1%. Capital investment up nicely at 2.7%. Those are some of the things on the capital investment that we see, again, shrinking a bit as those expectations and that concern grows. People and companies will start just doing a bit less if they expect business expectations to come down. They're going to want to hoard some of that additional money and some of that for a rainy day. GDP coming in right in line. But some of the pieces on the manufacturing side and some of the leading indicators that are so important, new orders were negative. Global manufacturing PMI, new orders negative, new export orders also negative. Again, these are two key leading indicators. Germany is an exporting nation, and both new orders and export new orders are both in contraction, showing that pain, highlighting what we've talked about and factoring in China and some of these other key pieces. German PPI, again, ripping through. Wholesale price index, again, ripping higher. Increasing price of exports, increasing prices to local consumers, putting that pressure and keeping it on people's throats. Business climate, again, nice little bounce, still at the lows that we saw in 2020. Expectations still holding at those low levels, which again, creating some of these problems. And then when you start looking at those expectations, so expectations for manufacturing negative, service sector negative, construction negative, trade negative. Again, all of these things are currently negative, and that's where when you start looking at spending, we see that shrinking factor, and that's going to, again, put a cap on where that economic growth and expansion can be in 2022. Now, when we turn to France, you can see that unemployment was right in line. Business confidence, again, also right in line. Production outlook indicator coming in slightly more negative at -9. Manufacturing missed estimates at 54.5. Service was actually pretty good at 58.4, and that put the composite at a nice beat of 57.1. So this was a nice little surprise versus what Germany was. But Germany, I think, is more of the leading indicator for where things are going. France, as we've said, will be a little bit of a bright spot in terms of where it is. It's more Italy, but again, France has some nice mixed numbers. But again, the German side, I think, is more indicative of the pressure, but they also have the most exposure to Russia as we talked about in the EIA show, on the refining side, as well as the natural gas side, which means that they're going to get hit the hardest. And because they are the largest economy in the European Union, that's going to provide some of those headwinds. But then some of the leading indicators, France, new export orders, again, firmly negative, and in contraction, more of that leading indicator as business confidence, again, also remains a bit soft. And that's, again, some of the key pieces. So the two largest economies have a little bit of a mixed bag in terms of where they are currently. But then when you look at where they're going and those expectations, I think Germany is kind of showing where this is going, how this is going to get there, and the pain and pressure that we expect to see. So that's what we have for you on Europe. In the next segment, we're going to go obviously deeper into China and Asia and what are we seeing happening within that continent.